But while the world looked at the chart, they ignored the decay. The chart looks like a victory, but your balance looks like a defeat. The noise is a weapon, and it's designed to blind you.
Pressure builds until the truth forces its way out.
This is where accounts go to die. Implied volatility. Stop gambling. Start engineering your edge. Welcome to the Masterclass.
Secure your edge. Click subscribe to master the professional side of the trade.
For years, you've been told the key to options is getting the direction right. That if you just master price action, MACD, or RSI, you'll win. But what if I told you there's a silent indicator that decides if you get paid even if you're 100% right on direction? It's not on your chart. It's what we, on the institutional side, call the market's attention valve. Today, we're going to pull back that curtain.
I know, that sounds completely backward, but it is the absolute truth. You can correctly predict that the Nifty or the S&P 500 will rally after a big announcement. You can buy a call option, watch the market go up, just like you said, and still lose money. And today, we're going to break down exactly why that happens.
And the reason is actually pretty simple, but it's a massive blind spot for almost every retail trader out there. You're watching the wrong game. It's kind of like you're playing checkers while the house is playing three-dimensional chess. And that is the invisible indicator. It's the market's anxiety, its anticipation, its focus. Now, on the trading desks, we have a more technical name for it, implied volatility, or IV. And learning how to read this is the real secret to options trading. Okay, so to really understand how this works, I want you to think of the market not as a chart, but as a pressure cooker. This is the exact framework we use to price uncertainty, and it's how institutions systematically collect what I call the attention tax. So look at this slide and follow the sequence. First, we apply the heat. That's an upcoming Fed meeting or a huge inflation report. Now, as that event gets closer, the pressure inside the cooker just builds and builds. That's your implied volatility rising. So you go and buy your option at peak pressure, paying top dollar for that uncertainty. Then, the moment the news is released, and it almost doesn't matter what the news is, the pressure valve opens. That hiss you hear, that is the sound of your options premium vanishing into thin air. You know, this phenomenon, it has a name. It's called IV crush. And it's not some accident. It's a feature of the market. It's the tax you pay for buying an option when everyone's attention is at its absolute peak. And guess what? Institutions are on the other side of that trade, selling you that overpriced insurance. So let's look at the first major trigger for this attention tax, inflation data. You know, for a decade, CPI reports were just background noise, but that has changed dramatically, and it's turned these releases into a total minefield for options buyers. And hey, you don't have to take my word for it. Research from the U.S. Federal Reserve was crystal clear on this. In that low inflation decade after the '08 crisis, the market barely even blinked at CPI numbers. But now, in the high inflation world we're in today, the reaction is absolutely explosive. The market sensitivity has just gone through the roof. And here's the real key takeaway from that. The market has an attention threshold. Once inflation crosses a certain point, investor attention just becomes laser-focused on this one data point. The CPI report goes from being a little footnote to being the main event. And that attention tax, it skyrockets. This chart illustrates the mechanism perfectly. The Fed study actually measured news intensity on the Bloomberg terminal, which, is the lifeblood of institutional investors. And during the high inflation period, news coverage around CPI releases just exploded. This is a direct measure of investor attention. So, you see, the market isn't just reacting to the data, it's reacting to the attention being paid to the data. All right, let's move on to our second trigger, central bank announcements. Have you ever seen the market rally after the Fed or the RBI delivered what sounds like bad news, and you're just scratching your head wondering why? Well, here's the institutional secret. This is so fundamental. We aren't betting on whether the central bank is going to hike or cut rates. We are betting on the collapse of uncertainty that happens the second that decision is announced. The outcome is almost secondary to the event just being over. The real profit comes from the change in volatility. And here is the proof, plain and simple. Just look at the VIX in the US and the India VIX. In the minutes right after a policy statement is released, they don't jump, they cliff dive. We're talking drops of 20% or more instantly. If you are holding a long option into that, you are fighting a literal landslide of collapse and volatility. You paid the maximum attention tax right before it was collected. Okay, now for the most counterintuitive trigger of them all. This is a trap that hides in plain sight. You might think those safe, stable stocks like an Apple or an HDFC Bank are boring, but from an institutional options perspective, that's precisely what makes them so dangerous.
This trap is called a gamma squeeze. Just think of it like this. When a safe stock makes a surprise move, the big banks who sold options against it are suddenly sitting on a massive amount of risk. They are forced to buy the stock itself to protect their position. And that forced buying pushes the price even further, creating this violent, ugly feedback loop.
So why the safe stocks? Well, because nobody expects them to move violently. The market for their options is priced for stability. And that complacency is what creates the absolute perfect condition for an explosion. This slide really breaks down the math behind the surprise. A recent academic paper actually calls this beta-normalized shock perception. So a 3% move in some high-flying tech stock, that's just a Tuesday. But a 3% move in a slow, steady banking stock, to a dealer's risk model, that's a 5-alarm fire. Their hedging reaction is completely and disproportionately aggressive. And this is how you get that feedback loop. The surprise move leads directly to dealer panic. Their forced hedging becomes the fuel that pushes the price higher, which then forces even more dealers to hedge. You see? This is how a tiny little spark in a safe name can turn into an uncontrollable wildfire. Okay, so we've identified the traps, we see the minefield. Now let's talk about the solution. How do you stop paying this ridiculous attention tax and actually start trading like the house? Let's just be really clear about this. The common retail strategy of buying a simple call or a simple put right before a big announcement, it is structurally flawed. You are maximizing your cost basis at the exact moment when implied volatility, the attention tax, is at its absolute highest. You are literally setting yourself up to fail from the start. So what's the professional solution? Well, you never take on just one side of the volatility equation. Instead of buying a naked option, we use spreads. This lets us control our costs and, in many cases, actually make that collapsing volatility work in our favor. And the most fundamental tool here is the vertical spread. It's really simple. You buy one option and at the same time, you sell another one further out of the money. By selling that second option, you're collecting premium. You're collecting the attention tax from someone else, and that drastically reduces the cost of your own position and cushions you against that inevitable IV crush. So here it is. This is the game plan. The professional's checklist. First, always check the implied volatility percentile. Is attention cheap or expensive right now? Second, identify if the upcoming event crosses that attention threshold. Is it a market-moving CPI print or just another data point? And finally, structure your trade to survive and maybe even profit from the IV crush. Use spread. So look, here's the real takeaway. The price chart, the tape, it tells you what happened. But implied volatility, that tells you what the market thinks might happen. Your technical indicators are all lagging. But this invisible indicator of investor attention, it's predictive. So the real question is, are you ready to finally stop paying the attention tax and start trading what the professionals are trading?